Luke Meyer, I appreciate you holding this hearing. And let me say at the outset that I share the stated goals of increasing transparency and accountability in international regulatory discussions. I think we should also be looking at governance and transparency reforms in domestic regulatory decision-making. I am concerned, however, that Congress may be exporting the state versus federal turf war into the international arena to the detriment of U.S. companies and consumers. We are at a watershed moment in international insurance regulation. The U.S. has much to gain by moving forward with a covered agreement on reinsurance collateral with the EU. Formal negotiations would give the United States leverage in discussions about equivalency under the European Solvency II regime. Simply put, without action, U.S. companies lose. They are either cut out of the European market or they are forced to post billions in additional capital, which is then unavailable to invest in the U.S. or to invest in emerging markets. Reforming arbitrary and discriminatory state reinsurance collateral laws through a covered agreement has been a bipartisan goal of this committee since 2010. Representative Kanjorski, the architect of the key language that we put into Dodd-Frank on this, said that covered agreements and preemption were designed to harmonize reinsurance standards across national borders. That was the goal. These covered agreement negotiations, I might add, are already subject to substantial congressional oversight, including a 90-day layover period, so there is little we need to fear in terms of a lack of transparency. In conclusion, Chairman, there is widespread agreement on issues related to domestic capital standards and increased transparency in international negotiations, and respectfully, if we're going to move legislation, we should stick to those issues and ensure that we're not intruding on the important covered agreement negotiations already taking place.
Chairman,
thank you again,
Mr. Toti, I have some questions to you as a reformed insurance commissioner, and much to my chagrin, and I assume yours as well, the NAIC hasn't prioritized collateral reform. And that's what I wanted to talk to you about, because in 2011, the NAIC certified reinsurer provisions. They're still not an accreditation standard. It's long time has passed. And a third of states haven't modernized their laws, including major states like Texas and Illinois. Moreover, states who have modernized their reinsurance laws have not done so in a uniform fashion, unfortunately. So, Mr. Toti, in November of 2014, you told NAIC's Reinsurance Task Force that you believed that uniformity is an important consideration and that this should be taken to the Accreditation Committee for further discussion. But then NAIC testified to us last September that it was going to, in November, start the conversation about accreditation for credit for reinsurance. That's a hammer we have, unquote. So with the model passed in 2011, seasoned 3 years, then referred by you as an important consideration in 2014, shouldn't the accreditation conversation have been finished rather than beginning in 2015? And why didn't the NAIC listen to you and gone forward and prioritized this?
Thank you for that question, Congressman. I just want to clarify, I no longer represent the NAIC. I cannot speak for the NAIC
But you could speak as a former regulator. I'm just trying to get to a point.
I can explain the accreditation process, and I can give you just a very brief description of why in 2011 it wasn't immediately ratified or considered to be an accreditation standard. And generally, the way the accreditation program works is that if a state implements a more stringent requirement than the accreditation requirement, it is in compliance with the accreditation program. Prior to the implementation of the new credit for reinsurance standard, 100% collateral was the standard, which was considered to be a higher standard than
Okay, well, let me ask you this then.
given NAIC's inability to act in the 6 years since Congress made this a priority, I assume you now support Treasury negotiating a covered agreement on collateral and using this as leverage in the equivalence discussion.
I do support equivalency and mutual recognition being the primary concern in the covered agreement discussions. It is absolutely necessary as an industry that we attain equivalency so that we are not disadvantaged when operating.
You support Treasury negotiating that covered agreement?
I do. Okay.
Now, I'd like to go to Ms. Carolyn Cobb, Vice President and Chief Counsel, Reinsurance and International Policy. So, Ms. Cobb, the purpose of this hearing is to examine whether international regulatory standards might be harmful to U.S. insurers. I'd like to clarify that I do not consider the new covered agreement negotiations to be an imposition of an international regulatory standard, but rather a bilateral discussion about removing barriers or potential barriers on both sides of the Atlantic, and an acceptance of each other's domestic supervision. Indeed, my understanding is that the U.S. insurance industry broadly favors pursuing the agreement because it is aimed at resolving the equivalence issue under Solvency II to the benefit of U.S. insurers operating in the EU. Is that a fair statement in your opinion, and does ACLI support the covered agreement negotiations?
Yes, it is a fair statement. We support the negotiation of covered agreement. Our board asked that state insurance regulators be included in those discussions, of course, as our prudential supervisors.
Well, I thank you. Mr. Chairman, I yield back.